There's a short section now. Let's have a look. Value-added tax. This can eat up a lot of value because it's hidden. Like in Australia, 10% value-added tax. In Singapore, I think it's 8.5 or 7.5% now. It started off as 3%. It just keeps on growing up. New Zealand, 12.5%. And it's added to different stages. And you might get it back or you may not get it back. Normally, as a tourist, you can go to the airport authority at the airport and give the receipts over and get money back. But you have to have certain, there's a threshold for getting that money back. But it's the same thing when you're exporting out of a country. You can get a VAT credit. And that happens out of China often. So my experience with my accountant in Australia, so I have a property in Australia, but once I actually bought a commercial property. I thought, oh, beauty, get more money with commercial property because they don't appreciate as fast, but you get a higher income. But with the VAT in Australia, the accountant said to me, oh, Neil, you need to put in a tax return every quarter. What do you mean every quarter? I said, yep, under the BAS, that's business administration system that's set up to get money out of businesses every quarter to pay for the equivalent of the VAT in Australia, goods and services tax. I said, oh, now I have to pay these taxes. And the accountant said, well, you're earning more income. Yeah, but I have to pay you more too. I said, how much more do I have to pay you? And he said, oh, about 2 or 3 times now. So instead of just paying the accountant $250 a year, now I'm paying the accountant nearly $1,000 a year. All right? So that's why there's a point, we're going to have a look at this. The BAS quarterly, here we go, sorry. The BAS quarterly statements in Australia, very costly administration. All right? Very costly administration because you've got to put in a BAS return every quarter, not once a year. Income tax is once a year. Okay, so we better change. Let me just change this. All right, so what I was just talking about with the BAS statements. BAS is an Australian system to get money out of businesses for the GST on their operations. So there's not individuals, it's just businesses. Okay, so if you conduct business, then you've got to pay goods and services tax on your business. And you've got to charge that on part of your invoice that you give to people. They pay you money for accountant fee, there's a GST on that, 10%. So my $250 accounting invoice has $25 on top of it for GST. Do I get that back? No. Okay, because it's a service, you see. All right. When I had my commercial property, I charged that GST to the tenant because the tenant's a business, you see. All right, and because I charged it, I had to file that return every quarter to say I've charged the tenant so much, you see. And then I had to give that money back to the government, what I charged the tenant. You see, and that's what, just so administratively complex. Okay, so that's administration, very expensive and subject to corruption. Okay, so in different countries, and there's corruption in every country around the world, but corruption with respect to when you're exporting out of a country, normally if there's VAT in a lot of countries, including China, India, and many other countries. They'll add VAT on during the process of manufacturing because raw materials come in, you paid VAT because the supplier of raw materials had to charge VAT, and then the manufacturer gives it to you and puts VAT on top of that. But when you export it out of China, you are able to get that VAT back. You can get it back. Okay, but the problem is that sometimes if you don't have a good relationship with the customs official, then they may categorise your exported goods into a lower VAT category, so you don't get as much back as you're entitled to. Can they do that? Well, you know, this is because things are not as transparent everywhere. This is what we mean by corruption, okay? All right, so corruption in terms of moving your goods into a category that has lower VAT than what you've paid, so you don't get everything back that you're deemed to get back, that you should get back. All right, so that's what we mean by corruption, okay? That happens. All right, so you know Chinese VAT is up to 17%. You know that? Okay, and you get up to most of that back. So you need to have a good, my friend that works with sourcing China, all right, he's able to get it back very quickly because you have a good relationship with the customs official. And that's still very, very important. Okay, so let's have a look. So when we consider value-added tax, notice that the effective income rate, the tax rate, is very, very high in a lot of countries. Switzerland's still pretty low. New Zealand's still pretty low. Hong Kong's still pretty low. But China's quite high. Okay, so you can see VAT is something that you cannot ignore. You cannot ignore. Okay, so let's keep moving here. Yes. No, this is a sort of aggregate of total taxes, effective taxes. Okay, and that, so income and VAT taxes. Okay, it's possible. So it depends on which goods you are or what services you are trading. Okay, that depends. All right, so in China, it's 17%. So we've got some examples here, 17% for some items and 13% and 6%. Okay, but it's possible, like there are strategies, and we talk more about that in transfer of pricing next week and the week after, where you can export out of China to get your VAT refund, but export it into a free trade zone and then import it back into China. Okay, so that's one of the benefits of the free trade zones and how foreign companies are working with free trade zones. Okay, they're able to do that because a portion of the raw materials are imported into China. Okay, and it's a way of them to, you know, moving that down a little bit more than what it would normally be. Some of the imported products for the Apple iPhone, you know, it comes in at 17%. You see, and that's why, partly why the iPhones are much more expensive in China, even though it's manufactured in China. Okay, because when it's exported out of China and goes to the US, you get a refund, but they don't get all that refund when they sell it in China. Okay, so that's why you see the big difference in the iPhone. It's not because Apple has decided that the price will be here for this country and here for this country. Okay. All right, more about that. This overlaps a little bit into transfer pricing strategy, which is next week. So I want to just make you aware of this. There's a rebate that's very, very important. And so when you talk to importers from China, it's very important to have agents that are able, that know about the VAT rebate, because, you know, a double figures percentage, that's a big amount. You can't ignore that. And if you miss out on that, boom, you know, you're out of competition. Okay, so we can keep going. And there was a VAT pilot program that affected inland companies versus other companies that are on the eastern seaboard, or VAT. If a supplier does not have a business establishment in China, then the withholding agent or recipient will pay VAT if they are established or reside in a city that has implemented a VAT pilot program. Okay, so they've tried to make it a little bit easier for new business establishments to be able to get the VAT refunds. Okay, and then there was export credit refund method and levy first refund later method. All right, and then okay. So let's have a break now. When you come back, I want to talk about tax jurisdiction, and then we're going to get on to double taxation and foreign tax income credits. But just to summarise what I've taken you through so far was more tax planning strategy and just a brief introduction to VAT. VAT is not something that you sort of plan your tax strategy around. but something that you need to be aware of so you can get the credits that you are entitled to. So you need to work with people that are VAT experts so that make sure that that happens properly. Okay, proper categorization of your products. Okay, and proper working with the officials, because sometimes you're entitled to it, doesn't mean you get it back immediately, because there may be a working capital problem where you may not get it back for another 6 weeks or 2 months. And you're out of pocket for 10% of your total shipment or 17% of your total shipment. Wow, that's a lot of money if your shipment's in the millions. Okay, so that's what I mean by VAT, but tax planning strategies, this is the bread and butter. Dividends, interest, royalties, thin capitalization. When we come back, we're going to talk about tax credits, double taxation, and it really applies to what we mean, it really applies to, if we understand that, really applies to, helps us with dividend strategy. Helps us with the dividend strategy. Do we pay? Do we don't pay? Do we just pay half? Do we pay full? When do we pay? See, dividends is total control of the company, when they pay and when they don't pay. All right, so that's what we're going to come into after the break, okay? Whereas interest, royalties and thin capitalization is more of a company structuring and a way of transferring money between companies, non-transfer pricing opportunities here, okay? And next week we're going to look at transfer pricing. So take a break, we come back, we look at jurisdiction, we look at double taxation, and then we're going to look at tax credits. Exciting stuff. Stay tuned. Thank you.